All right, welcome back. Today, we're doing something a little different. We're going to take our portfolios on a trip around the world. We're talking about global investing and why giving your investments a passport might just be one of the smartest things you can do. So let's jump right in.
So, first off, I've got a question for you, and I want you to be honest. Is your portfolio kinda stuck at home? I mean, really think about it. Are all of your investments tied up in just one country? If the answer is yes, well, you could be leaving a whole world of opportunity on the table.
And you know what? If you are, you're not alone. This is an incredibly common blind spot for investors. It's so common, it actually has a name: home country bias. It's just that natural human tendency to stick with what we know, to invest in our own backyard. But that comfort can really hold your portfolio back.
So what's the fix? Well, it's simple. We have to look beyond our own borders. In this first part, we're going to talk about exactly how to break free from that home country bias and really truly diversify.
Now, probably the easiest way to do this is with something called an international ETF. Don't let the name scare you. Just think of it like this. It's a single investment that's like a basket holding stocks from all kinds of companies all over the globe. It is a super straightforward and really effective way to get that global exposure we're talking about.
So why is this so important? Well, here's the core idea. Different economies have different cycles, right? The US market might be flat, while, say, Europe is having a great year, or maybe Asia is taking off. By spreading your money around, you're not putting all your eggs in one economic basket. It just makes sense. You spread out your risk, and you open yourself up to finding growth wherever it's happening in the world.
Okay, so for the first stop on our little global tour, we're heading to the world of developed markets. These are kind of like the big, famous, well-traveled destinations on the investment map.
You can really think of these as the reliable, stable spots for your money. If you're just dipping your toes into international investing, this is usually the best place to start. They're known for their stability, which makes them a really solid foundation to build on.
So what exactly makes a market developed? Well, we're talking about countries with really established, stable economies. They have strong legal systems, solid regulations. They've been doing this for a while. Think major players in Europe or places like Japan, Canada, and Australia. The key takeaway here is that the risk is generally lower.
All right, you ready for the more adventurous part of the journey? Now we're heading out to the emerging market frontier. This is where the potential for growth is absolutely massive. But you guessed it, so is the risk.
And this chart just lays out that trade-off perfectly. I mean, look at it. On one side, you have developed markets like Japan or Germany. You get stability, but the growth is probably going to be more moderate. Then you have emerging markets. Think China, India, Brazil. Here, the potential for high growth is huge, but it comes with a lot more risk and a bumpier ride. Understanding this difference is absolutely crucial.
And it's really important to go into these markets with your eyes wide open. The risks are very real. A sudden political shift, a big swing in a country's currency value, a surprise new regulation. Any of that can have a huge impact on your investment. That's why we call them more volatile.
Okay, so we get the what and the why. We understand the different destinations. Now, let's get practical. How do you actually build this into your own portfolio? Let's talk strategy.
So the big question is, how much? How much of your portfolio should be global? Well, there's actually a pretty strong consensus among financial experts. They tend to point to a very clear guideline.
And there it is. That's the number to keep in your head. A 20 to 40% allocation to international markets. That's a widely cited sweet spot for getting real diversification without taking on too much foreign risk. It's a fantastic rule of thumb to start with.
So here's your action plan, your checklist. First, choose your mix. How much stability from developed markets do you want versus that high growth potential from emerging markets? That's all about your personal risk tolerance. Second, select your scope. Do you want one simple ETF that covers the whole world, or do you want to get more specific in target regions like Europe or Asia? Third, think about currency. Big swings in exchange rates can affect your returns, so it's worth looking into currency-hedged ETFs to minimize that risk. And last but not least, always check the costs. Compare those expense ratios, because international funds can sometimes have slightly higher fees. It pays to shop around.
Okay, let's wrap this up with the key takeaways. Number 1. Home country bias is real and it can seriously limit your potential. Number 2, international ETFs are your passport to the world, a simple way to go global. 3, it's all about that balance, right? Stability from developed markets versus growth from emerging markets. And finally, number 4, that 20 to 40% allocation, that is a great target to aim for.
So I'll leave you with one last thing to think about. In a world like ours, where the global economy is always shifting, where economic power is constantly moving, is having a global portfolio really just a choice anymore? Or has it become an absolute necessity for long-term success? Definitely something to chew on. Thanks for joining me.